Hey, how's it going, guys? Hope everything is going well. I wanted to do this video on the crazy stock market drop that we saw in the last 2 weeks, or you could say like the last week. And it's quite crazy how it went from SPY 287-ish all the way to around 253. And it hit the SPX 200-day moving average, not the SPY. I had put a limit order on the 200-day moving order 200-day moving average for the SPY, but I should have done it for the SPX yesterday because you saw a crazy move to the upside afterwards. And my initial thoughts on this are crude oil. Late December, right? You started to see a decent rally in it, and the stock market kept on going up and up and up. You had also tax cuts, and this week you had that unwind. And last week I was also talking about how I was in these crude oil positions, or may have been a week and a half ago, and that I was kind of nervous because I wasn't making money on. I was actually losing money on these spread trades. I had some iron condors on, and what ended up happening was my short positions turned into winners, and then some iron condors, they were a bit rattled. But overall, it was better than it was in January for crude for me. And now what I decided to do the past week, I'm under on it, is I've sold some calendar spreads in the SPY or in the E-mini futures, and I also did some options trades when volatility was getting higher, right? I, unlike the institutions and some individual investors, were very foolish who were selling options when the VIX was at 8 and buying the XIV when it was at 8. You don't sell insurance to an arsonist. And that's what you do that's what happens when the VIX is very low at 8. For those individuals that got out of the trade before the calamity, congratulations. However, there were many institutions that were short vol, and I even talked about it like a year ago, right? I even did a Seeking Alpha article on it, that volatility, the way that positioning sizes, they're going to get crushed. And they did get crushed. I didn't expect it to be this week, but it happened sooner than I thought it would. Now, I wanted to go to another chart. This is at Slope of Hope. This Bear Tim Knight. I agree a lot with him on terms of libertarianism and markets and whatnot. And he had this chart where he was bearish on the XOP crude. No, what is a oil ETF? And now it's hit a level where it's set up for a bounce. So that's why I expect the market to go higher at least next week, and I'm going to get rid of one of my crude short positions in the futures market. But I will re-short crude because ultimately the hedgers are still very net short. They did probably unwind some of their short positions Wednesday, Thursday, Friday. So, and also in addition to that, you have the API numbers, EIA numbers coming this week, and I expect a draw or less production, and that's because of the bad weather in the United States. Now, I wanted to go look at another chart here, and this is at stockcharts.com. First chart I showed you was also from stockcharts.com, and this is the US 10-year and 2-year spread, right? This spread is at 78 basis points. So, the yield curve is still positive, so this is something to note, right? We don't have an inverted sloping yield curve. Once we go 0 or minus, I wouldn't want to touch the stock market. I don't want to even sell too many options in the marketplace. So that's just something to note. So I see a lot of gloom and doom headlines, right? In addition, this spread is hitting the 200-day moving average, right? I don't think it's going to cross it. I think it's going to actually go lower from here. So this is just something to note. for those individuals saying that, hey, this was the Bear Stearns moment. I think that this will happen under Trump. We will see some shakiness in the marketplace because of the 9-year bull market. Other chart I wanted to look at, I look at implied volatility and historical volatility, and I noticed that this week in the VXX, which I'm now short, I do have a long SVXY position. I also am long UVXY. That's to hedge some of my short volatility positions. But anyways, you see this volatility. It is greater than the historical volatility. So whenever you see the volatility go above the historical numbers, that usually means a mean reversion play is on the line. And over the past year, volatility, the VXX, is spiked to like 90, right? 89, 87. What was it at its peak this week? 146. So those buying volatility at these levels, right? I don't think that's the smartest thing to do at this level. And another note is, if you look at the VIX futures, right? This is in backwardation, right? The front month, February, which is going to expire on the 14th. So that is what? Wednesday, I believe. So this will eventually expire. And then March is only at 20. April is at 19. So the spread between March and April is very small compared to the widening gap between February and March. So this means that you have less backwardation between the front month and the second month. So that means that these volatility stocks, these short vol instruments, minus XIV, remember that one is going to go bye-bye, and the ZIV is going to go bye-bye. So I think those individuals who are now nervous about shorting volatility, this is, in my opinion, a better time to be shorting volatility rather than when the VIX is at 8. And I have like a minute or so left. But I looked at the commitment of traders data, and I also noticed that the commercials are now net short volatility in the VIX futures markets. And the last time they were net short was the time where you should have been shorting volatility. This was right when the market crashed in August. So this was August or September 8th, 2015. This is when the commercial hedgers were the most net short. And their timing was right? You shouldn't be going long volatility, in my opinion, when volatility spikes up to, what, 40, 50? I mean, I had to put in some precautionary measures just in case volatility shot up to 100, right, in my account. I just bought way deep out of the money put options in the futures account just in case I was wrong about the mean reversion play. But ultimately, buying VIX right now, I think, is crazy because there will be better opportunities. And one way to measure this gauge is to look at the futures market, the commitment of traders data, and all these funds were stupid enough to sell volatility at 8 or 9. And now they're trying to hedge their stupidity. And sorry for saying that, but that's the truth. Because I've done it myself and I've learned my lesson. These guys apparently didn't. And it's probably the younger types, right? My age types, the millennials. Now, like I said, the VIX should mean revert. Expect the market to go higher. However, I think volatility is going to be a little normal, like we saw back in the day, right? VIX hits 11, you're going to see volatility spike up, right? It's not going to stay at 9 or 10 like we saw lately. I think people are going to get smarter. Anyways, guys, please let me know what you think, and I'll talk to you later.